Hello, good morning, everyone. Thank you so much for hopping in today on Good Friday for this awesome presentation on life insurance settlements. We are going to go over a couple of quick housekeeping items before we jump into the presentation. So just so you guys are aware, today's course is CE approved. So you have to attend the course from beginning to end. If you log out early, you will not be eligible to receive CE credit for today. Also, you will be responsible for answering trivia questions throughout the presentation. So Lisa will pop up a trivia question and you will answer that in the chat or question box. Either one is fine. We will be documenting and recording that today. If you fail to answer a question, you also will not be able to get CE credit for today. So make sure that you're paying attention for those questions as they pop up throughout the presentation. If you have questions while Lisa's chatting, we encourage you to put them in the question box. I'll pop in and I will ask the questions for you guys so that you can get them answered right when we're talking about that topic. So make sure that you are putting your questions in as we go through the presentation. So without further ado, I'm going to introduce Lisa. Lisa and I stumbled across each other in an email exchange, which is par for the course these days, post-COVID pandemic here. Lisa is president of the, Lisa, I'm going to butcher this, Ryberg.
Close enough. It's Rayberg, but you can call me anything, including Hey Redhead. Totally fine.
Rayberg Life Insurance Settlements. She's been passionate about assisting people with financial, insurance, legal, and nonprofits all throughout her career in the life insurance policies. She's been doing this for over 30 years and has presented to hundreds of organizations, including various health underwriting associations throughout the U.S. So she has tons of experience in this, and she has a Bachelor's of Art and a degree in finance and a Master's of Art in organizational development. Lots of education, so I love it. Lisa, without further ado, I'm going to turn this over to you so that you can get started on our presentation today, life insurance settlements benefiting your client and you.
Well, thank you so much. And thank you so much for your time this morning. I really do appreciate it. And my heart is with health underwriters. As Amanda said, I've been in the business since for over 30 years, but I started way back when as a Blue Cross of California representative. So yes, I know your world. I know health underwriters. And like I said, it's a privilege to be here. So we're going to talk about life insurance settlements. Now, on the surface, you may be thinking, okay, Lisa, this is health underwriters. Why are we talking about life insurance? Because you can help your client and also receive a revenue opportunity for your agency as well. You do not need to be a life insurance expert. You do not need to write life insurance. You do not even need to be the writing agent on a client's life insurance policy. You can help your next door neighbor. You can help potential clients. These could be your business owners on your small groups. These could be your individual clients who may have parents that need help. These could be your Medicare clients. So there is a lot of opportunity here inside your normal routine books of business, once again, to help your client and you. So without any further ado, let's just jump right ahead. Here's our first trivia question. So I have $10 Starbucks cards. I have told Amanda to watch the chat box because whoever gets closest to the year the first life insurance company started in the United States will receive a $10 Starbucks card. And I'll email that to you later on today. Amanda's going to give me the winners and email addresses, and I will get that to you today. So what year did the first life insurance company start in the United States? Don't Google, no looking this up on your phones, just guess. Whoever gets closest will get the Starbucks card. So we'll give it a few seconds here, 10, 15 seconds. Give you a chance, just once again, guess. I'd hum Jeopardy, but you know, it would be nothing.
We got answers all over the place.
Okay, ready? Here we go. 1759 is the correct answer. So whoever got closest to 1759, I need to send you a $10 Starbucks card.
We've got Renee Lambert, 1776. She's the closest. Next closest was Karen Kite and Keith Nelson at 1815. So Renee it is.
Renee, it is. Well, congratulations, Renee. So 1759, Benjamin Franklin was involved in the first life insurance company. Of course he was. He was involved in everything else, right? The Declaration of Independence, that little kite and key thing, and the first stove, by the way. He helped to invent the first stove. So why not be involved in the first life insurance company? And it was called Presbyterian and Ministers Fund, and it was designed to help women and orphans in case something happened to the breadwinner of the family, which obviously back then and still today, very important. Here's the second trivia question. And we won't be doing this every page, I promise, ladies and gentlemen, but we are the leading insurance premium writing country in the world. The US leads the world in the amount of premium written. Who is number two? And this one, we're going to go with whoever gets closest geographically to the right answer. So what country in the world is the second leading insurance premium writing country? It may surprise you. Hint. Who is number two? Wait a few seconds here. Get answers coming in, Amanda?
Oh yes, answers. And actually, everyone's guessing China, Germany, the UK. We've got one Japan.
Hold it, hold it. China's number three. Japan is correct. Who got Japan?
Keith Nelson. Good
All
job,
right,
Keith.
Keith. $10 star, but Amanda, make sure I get these email addresses at the end, and I'll make sure I get those out today. But
You got it.
congratulations, Keith. That's right. Japan is number two. Aflac writes a lot of business in Japan. Go figure. So let's move on. Look at the number of life insurance policies that are in force today. Look at these values. These are really, really big numbers. There's a lot of life insurance policies, a lot of face value. Look how much was surrendered in 2015. That's pretty consistent. 2020 shows about half of that. It showed about $340 billion. I need to update this slide. But point is there's a lot of life insurance that is surrendered every year. Now, surrendering means I'm giving my policy back to the insurance company, and I'm getting any cash that's in it out. So in other words, people are giving up their life insurance policies to the tune of really high numbers every year. Look at the senior life insurance market. This is really important because typically for life insurance settlements, we are talking about seniors. Not always. We'll talk about that a little bit later. But typically the senior market, look at these numbers. They're absolutely massive. And the over age 70 numbers do not even include term insurance. So you and I both know that our population is aging, right? Like I am 28 in my head, but I've been in the insurance industry over 30 years. The date on my insurance license kind of gives it away. It tells me that I'm not 28 in my head. But our senior population is aging, right? I'm aging. The insurance agents and brokers that I've been working with forever, they're aging, their clients are aging. So you can see what the estimated number of seniors is going to be by 2030. It's going to be huge. So my point here is this market is large now. It is going to continue to increase and continue to be more valuable going into the future. And here is my personal passion. This is why I do what I do. 500,000 seniors a year will lapse their life insurance policies. They just stop making the premium payments on it and they let these policies go. And when this study was done, which is about 7 or 8 years ago now, only about 1,250 took advantage of a life insurance settlement that year. Last year, that number has increased a little bit. It was around the 3,000 mark, but still, that's a really big gap, right, between 500,000 seniors who are letting their policies go and 3,000. Now, I am not going to tell you that all 500,000 of these seniors could have sold their policies. That's not true. But I will tell you that an awful lot more than 3,000 could have. And the reason? They had no idea. They just did not know. So you can see that 90% of those seniors that were surveyed said, had I known about it, I would have at least considered it. And that is what this is about. just giving clients options so that they don't walk away with little or nothing from their policies. So what is a life insurance settlement? Think about your life insurance policy like your car or your house. It's an asset that you own, any type of life insurance policy. And the process of selling a policy is called a life insurance settlement, or life settlement for short. I like life insurance settlement because it's more descriptive of what it is. Life settlement to me sounds like you're planning a cemetery plot, but that's just me. So I always have to call them life insurance settlements. But if you hear life settlements, it's the same thing. The industry has just shortened it. Point is, it is just a financial transaction. So a client will receive a lump sum of cash. And the buyer, typically investor groups, will talk about that, will become the new owner of the policy. They will pay the premiums and they will be the beneficiary. So the investors are not doing this out of the goodness of their own heart, but it works out well for clients because they're going to walk away from these policies with little or nothing, right? So at least they have more than that. So they receive cash. The investors are doing it as an investment, and we'll talk about why they're doing it as an investment later, but that's what they're doing. So think about when you sell your car, you sign the pink slip over, right? You get cash, you sign the pink slip over to the new owner and they drive off. Very, very similar. So the process of selling life insurance policy is called a life insurance settlement. But Lisa, I've never heard of this, or I might have heard of this a little bit, not real sure. Is this even legal? Yes. And will it surprise you to know it has been legal since 1911? So little backstory on Grigsby versus Russell, because I'm an insurance geek. I love the backstory on this. This is a Dr. Grigsby and a Mr. Russell. This is a Supreme Court decision, and here's backstory. There's a Mr. Bouchard. Mr. Bouchard was fairly well off at some point in time, and he bought a life insurance policy, made a couple premium payments on it, and then he started to fall into financial difficulty. And he had some health issues. And he goes to Dr. Grigsby, and Dr. Grigsby says, you need surgery. And Mr. Bouchard is like, I, can't afford surgery. Dr. Grigsby says, I'll buy your life insurance policy. And that way, that's payment for the surgery. Now, I'm not real sure that I would sell my life insurance policy to my surgeon, right? A little dicey there. But Mr. Bouchard did, and in Dr. Grigsby's defense, Mr. Bouchard did live for about another year, and then he passed away. Mr. Russell comes into play because he is Mr. Bouchard's executor of his estate. So now you can kind of see where this is going. The life insurance company says, we know we owe somebody. Who do we owe? Because Mr. Russell says, no, you owe me. Dr. Grigsby says, I bought the policy, you owe me. This goes to the Supreme Court. And Justice Oliver Wendell Holmes, in his statement of decision, sides with Dr. Grigsby and says, here we go, a life insurance policy is an asset that you own, and you can transfer that asset to anybody you want, anytime you want. Thank you, Justice Oliver Wendell Holmes. That is what makes our market go. So I can transfer my life insurance policy to any of you today. It's just a change of ownership form that every insurance carrier has. I sign it, I put your name on there as a new owner. It's kind of like the pink slip, and send it into the insurance company, and you now own my policy. And you can do with it whatever you want. Don't tell my husband, but you know what I'm saying. So that is what makes our market go. But nothing really happens with it until the mid-'80s. And we have what's called the AIDS epidemic happens, and we have what's called viaticals come into play. So the term viatical may seem somewhat familiar to some of you. Viaticals come into play mid-'80s, somewhere around there. Because remember, if I was diagnosed with AIDS in the '80s, I had a very short life expectancy, right? Couple of years maybe. And so AIDS patients were selling their policies to be able to pay for experimental treatment, or maybe go on their last around the world cruise, whatever they wanted to do. That's where the market started. Now, I live in the West. I'm in Southern California. We do work nationwide, by the way, but I am in Southern California. And so I like the West. Obviously, I live in the West, but I don't like the Wild West. The '80s, Wild West. no regulations. You can do the math on how crazy this looked. And indeed it did. So viaticals sometimes might have a negative connotation. That is because of the Wild West of how the market started. That is not where we are today, and that is why I have this slide up. Because the Life Insurance Settlements Association, LISA, see, I was meant to do this, Lisa, started in the mid-90s. They worked very heavily with NCOIL, the National Congress of Insurance Legislators, and the NAIC, the National Association of Insurance Commissioners, to develop model language, consumer protections, HIPAA protections. Everything we do is regulated. Today, we are a highly regulated industry, so not only do I have to have special licensing, the applications we use have to be approved. And those applications do have language in them that the departments of insurance across the country mandate disclosures that clients have to sign off on. The providers, we call the buyers in this case providers because they're providing the money. A little bit different than health underwriters, right? I had to get used to that term because to me, my old world, providers are like hospitals and doctors, right? Not here. Providers are the buyers who provide the money. But bottom line is the providers have to be specially licensed or registered with the state through the Department of Insurance. Typically, they'll have to post a bond. They're going to have to demonstrate HIPAA protections. They're going to have to demonstrate a lot of things before the Department of Insurance will allow them to buy policies in their state. It is an approval process. It's not like someone can just pop up tomorrow and say, let me go buy an insurance policy. Not at all. And in many states, the buyers do need to provide the states a listing of the policies that they're buying every year because we want to have that transparency, don't we? We want the Department of Insurance to know the names and everything else of the policies that are purchased for trackability purposes and for compliance purposes. There's a lot of compliance here. These providers can and are audited. Really, really important. So that's a long-winded story for it's legal and highly regulated by departments of insurance across the country. So here's one of the big questions. Why in the world would anybody want to sell their life insurance policy, right? Well, I alluded to it earlier. There's 500,000 different reasons, but typically here's what we see. Clients just don't want the policy anymore. They don't need the policy anymore, or they can't afford the policy anymore. What I bought my policy for 20 years ago is no longer a concern. My spouse has passed away, the kids are gone. I bought it for when the kids were young so that if something happened to me, they could go to college. And they're out of the house now and they're on their own. There's so many different reasons why someone would want to look at selling their policy. The bottom line is the policy has outlived its usefulness. Here's the 7 most common reasons we see. Now, these are in no particular order. I have a business and I've sold it. So small group brokers on the line, here we go. You have business owners who are retiring from their businesses or they have sold their business. They don't need the key person policy anymore. That's a good reason to sell. Or I have rental properties. I talked to a doctor in Arizona. I have rental properties and I have sold the rental properties. So I bought a life insurance policy to pay off the rental properties in case something happened to me, but I've sold them. My estate has declined in value, so I no longer have an estate tax issue. Or because the Tax Cut and Jobs Act, my estate is now subject to exemption. So before 2017, I may have had an estate tax issue. Now, because the exemption's been doubled at $22 million for a married couple, my estate is underneath that. I don't have an estate tax issue anymore. Or once again, my estate has shrunk. I see 4, 5, 6, and 7 a lot. These are the most common reasons that I personally see. I have a term policy and it's coming to the end. I'm not going to convert any part of it. I'm not going to continue any part of it. It's done. It's lived its life. I'm done with it. Or I have a term policy that's coming to the end of its conversion privilege, and maybe I want to convert part of it to a universal life or whole permanent policy. Well, don't let the rest of it go to waste, right? Let's sell that part of it. I've retired and these premiums do not fit in my retirement budget. Or like I said, I've retired and my spouse unexpectedly has passed away. I don't need the policy that had my spouse on as a beneficiary. Number 6 is very common. This is typical with universal life policy. I'm going to backtrack one step. There's two different types of policies. Term policies are like renting. Term policies do exactly what they say they're going to do. You have coverage for a certain amount of time, 5 years, 10 years, 15 years, 30 years. That's your coverage. That's your term limit, right? You have level term premiums that entire time. Permanent types of policies are universal life and whole life. They are more expensive than term. But the reason they're more expensive than term is, number one, they don't end, right? And number two, the premiums have a savings component, if you will. So I'm going to pay more in premium. Part of that's going to go to the cost of insurance. The other part is going to go to a savings account type feature called cash value. So what has happened is universal life policies that were purchased typically in the 90s and early 2000s, when they were purchased, the cash value in that policy was projected to grow at 6, 7, maybe even 8% a year, because that is the interest rate environment we were in back then. But have we been in that interest rate environment for a long time? No, right? We've been in a really low interest rate environment for like, what, 15 years, probably longer. And so what's happened is the cash values that were illustrated to jump like this have actually grown like this. And clients are finding themselves in their 70s and their 80s. And what's happening is the cash is being chewed up every single month, because as we get older, that cost of insurance goes up, right? So the cash was supposed to be here and last for a long time, but it's not. It's here and it's getting chewed up. So we call that blowing up or imploding. These policies are imploding, and clients have to put more money in the policies to keep them going, and they either don't want to or can't. So we see universal life policies in particular blowing up and imploding all the time. And the last one is chronic illness. I need to find ways to pay for assisted living or memory care, either for myself or my spouse. And selling a life insurance policy can be another way to do that. Maybe I don't have long-term care insurance. Maybe I want home care. Maybe I want to stay home. Maybe I need to make modifications to my house to make it more wheelchair accessible. Whatever it happens to be, chronic illness can be another way, another reason for people to sell their policies. I have people that they're younger people that have cancer, and they have sold a life insurance policy because this gentleman said, look, my family's going to be fine. I've had a great career, and I just want to sell my policy. And he had a number in mind, and we met it. But the point is, I want to sell my policy because I want the private health care that I want for, till I turn 65. And he was age 57 at the time, had cancer, manageable cancer, but still had cancer. He's like, I just want that for my health care needs. So here's the good news. You don't have to be a life insurance expert. Remember that? Any type of policy can qualify for life insurance settlements. There's no type of policy that's off the table, if you will. Once again, I'm not telling you that all policies sell. What I am telling you is all types of policies can qualify. So you might be asking yourself, Lisa, you just told me that term is renting. It's only here for a certain amount of time. How in the world can you sell term insurance? And in fact, term is the number 2 seller. Universal life is the number 1 seller. The reason term policies can be sold is that they are convertible to a universal life or whole life. So 97, 98% of the time, term policies, in order to be sold, need to still be convertible and not pass the conversion deadline. So if you look at your life insurance policies, you're going to see something called a conversion option. Sometimes the carriers will call it exchange option, but typically called conversion option. You will have the ability to convert this policy without medical underwriting to universal life or whole life or whatever policy the carrier has available at that time. But there's a deadline. And every carrier is different, and sometimes policies inside the same carrier are different. So dive into your policy and you will see they will either put in the data pages up front that here's your conversion deadline, or sometimes they'll bury it, and you can read the clause. And what it'll generally say is you have a right to convert this without medical underwriting to a universal life or whole life policy or another policy that we have up until I've seen an age 65, age 70, age 75. I have seen to the end of the term. I have seen hybrids, meaning that to age 75 or 10 years on the policy, whichever one is less, whatever it is, you will see that. So point is 97, 98% of the time, term policies need to be convertible and not past the conversion deadline. Now that leaves 2 to 3%, right? There are some policies that are, and I should backtrack a quick second. When there's a term policy, when the term ends, you can still continue that term policy. It goes into what us geeks call ART, or annual renewable term mode. And what happens in annual renewable term mode is exactly what it sounds like. So my level term premium is here. Once that term ends, annual renewable term premiums go up really high, and they will go up every single year, and they go up really high, really fast. That does not excite investors because it's not a predictable premium flow for them. It's not predictable cash flow. So they really don't like that. But I mentioned 2 to 3% of the time, non-convertible terms can be sold. So every once in a while, we'll see a term policy that is written as annual renewable term from the beginning. And if that's the case, those premiums don't jump up as high every year. So that can make a policy marketable. Or when a policy has ended that level term and now we're in ART mode or about to go into ART mode, clients can still sell their policies, but because of the unpredictability of the premiums, they really need to have much more significant health issues in order for those numbers to work for investors. So not telling you it's impossible. I'm just telling you, if someone is 66 years old and healthy and going into ART and it's not convertible, that is going to be almost impossible to sell. So I am going to stop right now and just ask, does anyone have any questions? Are there any questions in the chat box or in the question box?
Currently, no questions in there. I don't
Okay.
know if they're like me, they're just soaking up all of this. You think you know everything about life insurance when you're selling it, but learn something new every day. We do have a question from Miss Karen. She says, who buys the policy? Just investors?
Yeah, they tend to be investor groups. And Karen, that's a great question. If you'll permit me a few more slides, I'm going to answer that. I'm going to go into more details on that. But yes, these are investor groups typically. So when you sell your car,
we have one more question that came in.
Good.
It's from Miss Renee. She says, can an employee, we have lots of them popping in now. Can an employee sell a group term life policy?
Yes, they can. Group term life or group UL life or what a group life in particular gets more challenging for a couple of different reasons. The short answer is yes. The longer explanation is it depends. It gets a lot more challenging because every group policy is different. Here's the key. The key to selling group policy is twofold. One is it has to be portable or convertible to an individual plan, right? An investor group, a buyer is not going to buy a policy that a company holds. They want to control this policy. So the employee, ex-employee, retiree, whatever, needs to be able to own that policy. And last time I checked, a lot of the group policies are convertible or portable to an individual policy, and that makes it fine. The other side of this that can be a challenge, and this is where the client, you or the client both, are more involved in getting us rates, because trying to get rates on converted group policies to show what the premiums look like into the future can be a challenge. But the short answer is yes. It just takes a little bit more legwork to do it. I'm working on the policy of a lady who used to work in the CIA. How cool is that? And I'm working with her daughter. So, and it's just a little bit more involved, but the short answer is yes, we can. It's just a function of getting it's portable or convertible to an individual policy, and for us to be able to get the information about the premiums. So good question.
Next question is, will you be going over the amount of money you can get from a policy?
Yes. Next question.
Perfect. That's the last question that's in the box.
Okay, here we go. How can the proceeds be used? So when you sell your car and you sell your house, are those proceeds restricted in any way, right? Those are assets, you sell them. Are they restricted? No, right? Same thing. I sell my life insurance policy. It's an asset. I own it. I can do anything with the proceeds that I want. So I can supplement my income, i.e. I can buy annuities. I can save more money for my retirement. I can pay for medical expenses. I can donate to my favorite nonprofit. I can pay off my mortgage. I had a client pay off his car. Lisa, I'm paying off my car on Monday. So anyway, the proceeds are completely unrestricted. And this is a key here. And I'll probably talk about it a little later on, but I'm going to jump the gun here. Think about this. Once your client has a lump sum of money, they may need new products. They may need products that you offer, such as annuities, maybe long-term care insurance, maybe other types of insurance. So besides receiving money from the settlement, which we pay commissions, so I'm jumping the gun a little bit. We do pay commissions. There's commissions there, but there also can be additional commissions on additional product sales. So more is better. What in the world are we talking about here? What we're talking about is term policies inherently have no value, right? There's no cash in there. There's no savings component in there. Universal life policies and whole life policies do have that cash component. So when we sell a term policy, anything we get for a term policy is a bonus, because once again, clients are going to walk away with zero. But what happens if I do have the universal life or that whole life and I have that cash in there? Can a life settlement bring me more money? Short answer is yes. It can, significantly more. And let me tell you what we're talking about. Let me show you proof. In 2002, the Wharton School did a study and looked at about 1,600 policies. And you can see the difference between the cash surrender value and the life settlement value. So let me qualify this real quickly and just define cash surrender value. So I have universal life, whole life, same thing. I have cash in my policy. I can surrender that policy back to the insurance company and basically give back my life insurance policy and get that cash out of the policy. I'm no longer insured, but I have the money. Now, cash surrender is that over the course of time, when these policies are written, there's going to be a surrender charge. It's almost like a what do they call it? Pre-penalty, pre-withdrawal penalty out of a CD, right? There's going to be a surrender charge. So I can get my cash out, but there's going to be a surrender charge that it decreases over time. So at some point in time, it's going to be zero. But the cash surrender value is my cash value minus any surrender charge, cash surrender value. So you can see here, the Wharton School found that had these clients surrender their policy, they would have gotten $93 million, but instead they sold them and they got $336 million, so about 4 times the value from surrendering. The GAO report shows about 8 times. This report is skewed significantly, but I put it in here because it's the GAO. This report is skewed because this was done in the go-go days of life settlements. And what I mean by that is if you were selling your policy in 2005, 6, 7, 8, you did really, really well, because buyers were overpaying for policies at that particular moment in time. They wildly missed on underwriting, way overpaid, couldn't support the premium payments, and basically imploded. So the buyers are no longer, most of those buyers are no longer here. If I was selling at that time, I did well. So these numbers are skewed. They're showing about 8 times. That's not accurate today. So 2013, London Business School, much more accurate, longer time horizon, 9,000 policies, and their results paralleled Wharton. So their results were about 4 times value. So like we like to say that selling a policy will generate 3 to 5 times cash surrender value. So I shout from the mountaintops as much as I possibly can. If you have a client who is going to surrender their life insurance policy, please look at a life settlement first, because they could be leaving money on the table. Example, we just sold the client's policy in Florida, $250,000 universal life policy. It had $15,000 of cash in it. And he just received a wire transfer for $90,000 by selling it. So he was going to let this policy go. It was a universal life policy that was blowing up or imploding. He knew he was going to have no money in like 3 or 4 months in the policy. His financial advisor said, call Lisa, look at a settlement. And he received 6 times. He received $90,000. So here we go. All right, Starbucks card.
Oh, I'm sorry. Can I Before we jump to the next trivia question, Karen has some really good questions, I think, just really tie into what you were
Okay.
just talking about. So
Okay.
she says, if someone has a large life policy, can they sell a portion because they don't need as much, but still would like to retain a portion until, let's say, their other investments cover the life, making them self-insured on life, so to speak? So that's question number one that she has. And question number two is, what is the process for having the policy reviewed, and what's in it for a broker if they recommend this to their clients?
Okay. So I will talk about the process in a couple of slides, Karen. So if I don't answer your question, it's a 3 to 5 month process, bluntly. Think about this like selling real estate. We're like life insurance agents for life insurance policies. What's in it for you? The WIFI. I love this because when we get to those slides, we'll just go through them much more quickly. So we'll go flying through those. The WIFI, what's in it for you is a couple things. First of all, obviously taking care of a client, right? People do not know that they have an option with their life insurance policy like this. We're the last option. They've already talked to you about all their other options, and the decision's been made to lapse or surrender the policy, right? We're the last option. They do not know this is an asset that they can sell. So they're so thrilled to be able to get money. So number one, take care of a client, obviously. Great way to attract new clients as well. Because once again, I've talked to financial advisors and insurance agents that picked up new clients because their other advisors never told them about this. The direct WIFI is the commission. So we will pay commissions on the sale of the policy itself. So we just wrote a check to a Medicare agent of $12,500 on a policy, and I will show you what those premiums, what those commissions look like when we talk about how much policies can be sold for. And also, once again, additional product sales, because now a client has $90,000, they may need an annuity, or they may need long-term care. Maybe even if it's not on themselves because they can't qualify, maybe they have health issues, but on their healthy spouse. So there are a lot of different positives for a broker. And did I answer the questions?
Yep, you did. Okay, trivia question time.
Trivia question time. Here we go. Get ready, everybody. Who's this guy? The first person to answer this question gets the $10 Starbucks card.
We had a good answer already.
All right, good. Who is it?
All right, we have got answers are all over the place, from Warren Buffett to my old neighbor to Bob Smith, but we have Wizard of Omaha is my favorite so far.
Who was the first person to answer Warren Buffett or Wizard of Omaha?
Bresson, Mackerg Bresson. Hopefully I didn't butcher your name. I'm sorry if I did, but that's who.
All right, perfect. $10 Starbucks card coming your way. Yes, this is Warren Buffett, the Wizard of Omaha, the Sage of Omaha, however you want to define that. Yeah, he's no dummy, right? He's been investing in life settlements since the mid-90s. Here's another guy. This is Steven Schwartzman from the Blackstone Group. So here's the answer to who these investors are. These are big money people. These are hedge funds, mutual funds, college endowment funds. This is going to surprise you. The state of Michigan has $500 million invested in these. And it's not just US funds. There are European life settlements who love life insurance policies from the US. Now, why are these investors doing it? Obviously, the first answer that probably comes to your mind is, well, there's good returns here. And there are. The returns on average are 9 to 13% a year. But there's another reason why they do it. It's a diversification tool. Life insurance policies are not tied to what's going on in the stock market, not tied to what's going on in the bond market, not tied to world events at all. So they are taking a small slice of their billions of dollars in their portfolio, and they're buying a non-correlated asset called a life settlement for the returns and diversification. So there's the answer to who these investors are. This is not your next door neighbor buying your life insurance policy, which is a little creepy. Here's the answer to how much our policy's worth. So let's put our Warren Buffett hat on for just a few minutes. Let me tell you what the investors are looking for and how they value a policy. They're looking for, number one, what is the premium that they're going to have to pay? Number two, how long are they going to have to pay the premiums? And number three, of course, what is the death benefit they're going to receive? They're all a little different, meaning that we have access to about 30 different providers, and those providers have multiple funds behind them. But bottom line is, they're all a little quirky in terms of what they want. We actually have one provider that just wants to look at people that have cancer stage 3 or higher. That's very unique. Obviously, that's a niche of a niche of a niche of a niche. But some of these buyers don't want to look at VUL policies, variable universal life. Some of them don't want to look at policies under 500,000. Some of them don't want to look at policies under $1 million. But that's why we have so many, just because, so we can cover the market. But the point here is that basically, when they're looking at a policy and evaluating it for what they want to offer, they're looking at premium, life expectancy, and death benefit. So the lower the premium is as it relates to the face value of the policy, the more valuable that policy is, because the investors have to pay less into it. The shorter someone's life expectancy is, the more valuable that policy is, because the investors are going to get the return faster. And obviously, the higher the death benefit, the more valuable the policy. So let's talk about these three examples. These are all term policies, by the way. The first one is a gentleman in North Carolina, lovely man. He's 78 years old. He does have cancer. This is a non-convertible term, by the way. He had 5 more years on his policy, and he is not in a viatical situation. He is not in that 2 years or less to live category. He has a longer life expectancy, but he does have cancer. So he's obviously, his life expectancy is obviously shorter, but he had another 5-year tail left on this policy. So you ask yourself, because I do, why do you want to sell your policy? And this is fairly typical. I bought this policy for my wife. In case something happened to me, she'd be able to pay off the house and have a comfortable life. But I lost her 4 years ago. The beneficiaries are my kids, my 2 daughters. They don't need this money. They have successful careers. They're married. Their husbands have successful careers. So if I can sell my life insurance policy and make my life more comfortable, then that's what I want to do. The opening offer on Vernon's policy was $15,000. By the time we were done, it's $128,500. The commission on this was $28,500. So the Medicare agent who referred Vernon received $14,250 on that. So that was an answer to your commission question as well. And so in this particular case, the buyers knew Vernon probably had a shorter life expectancy, obviously, but there was a 5-year tail of smaller premiums, so that once it went into ART, even if they had to pay, a couple of years of ART premiums, they were still going to be fine from an investment perspective. Number 2 is Al here in California, 68-year-old gentleman. He does have some health issues, but no cancer, nothing, that significant. Interestingly, this policy was convertible, but the buyer chose to keep it as non-convertible and pay the higher ART premiums. In Al's case, the policy was ending, and he wasn't going to convert any part of it, couldn't afford it, didn't want to afford it. And once again, he had some issues, but it wasn't, terrible. And his house was paid off, and he just didn't need the policy anymore. So for him, this is found money. The policy opening offer was $50,000. On the time we were done, it was $75,000. There is $20,000 of commission in this one. So the agent who referred Al received $10,000 of commission. So we share commission 50-50. We do all the work and share commission 50-50. The last one's a friend of mine, 72-year-old, beautiful redhead, healthy. She's in the same situation as Al, in that the policy was ending. Wasn't going to do anything with it, didn't really need it anymore. House paid off, husband's fine, everything's good. And once again, she's healthy, so why do I need this thing? I really don't. And for her, the opening offer was $6,000. By the time we were done, it was $8,000. And she was thrilled. She's like, Merry Christmas to me. We funded right before Christmas. Merry Christmas to me. I was going to walk away with $0. All of these people are going to walk away with $0. And so we were able to get them money for their policies. The commission on that one, obviously it's a smaller policy, was about $500 for the referring insurance agent. So are there any negatives? Yes, and I know we have like 14 minutes left, so I'm trying to go as fast as I can here. The proceeds can be taxable. I'm not a tax professional, So please consult your tax professionals, right? We always tell people to consult their CPAs and tax professionals. But here's what I do know, that the premiums that are put into a policy are a basis. It's what clients have paid for this asset. So if the settlement is underneath that basis, like in my friend's case, for sure, she was not going to have any taxes owed on that. Anything over that basis is typically long-term capital gains. But once again, all the clients usually don't have any issues with taxes. I've never had a client have issue with taxes because, once again, they're benefiting from this, right? Versus walking away with little or nothing. So even if they have to pay taxes on capital gain, long-term capital gains on a portion of the proceeds, they're totally fine with it because they were going to have zero or very little. But being able to obtain additional life insurance can be an issue. Sometimes carriers are asking these days if somebody sold the policy in the past, and if they have, then it's not going to be, the policy won't be issued, the new policy. I don't think that's a big deal, because if you wanted life insurance, you wouldn't have sold your policy. And obviously this does not apply to those final expense policies if someone just wants 15 or 20,000. Government funding reduction. What I mean by this here is if I'm on Medi-Cal or Medicaid, clients will be 1099'd in January. That can impact any government funding programs that people are on. I would refer you to a good elder law attorney. The ones that I have talked to know how to handle that. We're working with a client right now that is exactly in that situation, and the policy has been put into an ILIT, an irrevocable life insurance trust. So that is now the owner of the policy, before we sell it, of course. And so the proceeds will be going into that ILIT. So whoever owns the policy, or whatever owns the policy, will receive the policy proceeds. In this particular case, it's going to be the ILIT receiving the proceeds to protect the client from their Medi-Cal approval. So the Medi-Cal funds are getting. And the last one's creditor debt. If I'm in bankruptcy and I sell my policy in bankruptcy, the creditors can get that. But if I'm through bankruptcy and my policy, I still own my policy and it's not, promised to anybody else, there's no assignment on it or anything, not a problem to sell it. We do it all the time. People have bankruptcies in their past all the time. As long as there's no assignment on the policy, it's fine. And even if there is an assignment on the policy, like I'm working on one right now, if the creditor releases it, it's going to be fine as well. So point is, if there's bankruptcies in the past, it's totally okay. Bankruptcy courts typically do not know that there is that the life insurance policy is an asset that can be sold. So I've never seen one that has been promised to creditors. Here's the answer to the question about the process. This is a 3 to 5 month process. Think selling real estate. 1 through 4 is what we do. So it starts with an application. There's no application fee. A copy of the policy is nice to have, not a gotta have. We obtain medical records. So part of the application is a HIPAA release form. So for us to obtain the medical records, that is how the investor groups will underwrite for life expectancy. The clients do not have to go get a paramed exam. They don't have to go to the doctor. They don't have to do any of that, all based on medical records. And we also get an illustration that shows the premium projections moving into the future. We take that, tie it up in a pretty red bow, and send it out to as many investor groups as possible that will fit their parameters I mentioned. And then an offer is made or it's not. Offers are made or they're not. And what happens is, if an offer is not made, client just walks away. They're not out of pocket any money. They don't, there's no risk to them to find out, right? If an offer is made, they are not obligated. So our role, our fiduciary duty as brokers, is to get as much money for a client's policy as we possibly can. Our job is to market the policy. We're on team client the way you're on team client. And you can see the value of what we do through Vernon and through Al and through the client. Remember, I was telling you we got $90,000 for him. The opening offer on his policy was $20,000. So our job is to run up the bill for the investors. The investors do not want to pay. They want to pay as little as possible, right? So because we leverage them against each other, we can drive up the offers for clients. And then once an offer is made, the client says yes. Remember, they're not obligated. But if they say yes, think thick contract. It looks like selling a house, because remember, this is regulated by the states. Most of the language you're seeing in the contracts is mandated by the states, and also these contracts are approved by the Department of Insurance. So contracts can't be altered except for sale price and who's selling it. They are what they are because they're approved by the Department of Insurance. And once the contract is completed, it will go into escrow. Sounds like a house, right? Very similar to real estate. That's when the change of ownership, change of beneficiary form go into the carrier. Once the carrier processes those documents and tells the escrow company they've been completed, escrow's closed, and within 1 to 2 days, the client will receive their money either by wire transfer or by overnight check, whatever they decide. Inside the contract is a disbursement request form, and they can choose which option they would like. So transparency, a lot of consumer protections here. You already know how regulated it is, but here's some additional consumer protections. Number one, commissions are disclosed, and clients need to sign off on that. So that's really important, and commissions are negotiable. Number two, not in any particular order, but beneficiaries have to sign off. Everything we do is above board. We don't want anybody not knowing what's happening, and we don't want mom or dad to pass away and the kids going, hey, where's that life insurance policy mom told us about? And it turned out mom sold it 3 years ago. We don't want that to happen. So beneficiaries have to sign off. And also inside that contract is a doctor letter. It's already pre-printed. It's right there. The doctor just needs to sign it and stamp it that this person is of sound mind to complete this transaction. And if they're not, then they're power of attorney. So a lot of consumer protections here. I know we have just a couple minutes, so I'm flying through this pretty fast. Here's some typical myths about life insurance settlements that when I speak with insurance agents or financial advisors across the country, I hear. And the first one is, oh, Lisa, you only want those universal life policies. You can't sell term. Now, here we go. $10 Starbucks card. Ready? We can sell term policies. 97 or 98% of the time, the policies need to be what? So the first person to answer correctly gets the Starbucks card. 97, 98% of the time, the term policies need to be what? So Amanda, watch that chat box.
I think Alexis popped in before you even finished the question. She was fast. I think she's got the right answer. Convertible. That's exactly what she said. So
all right, Alexis. Great job. So perfect. So $10 Starbucks card coming your way. Most people do not sell their policy to pay medical bills. People think, oh my gosh, people have to be desperate to sell their life insurance policy. This would be the last thing that they would do because they absolutely need the money. Not true at all. 95, 96, 97% of our clients are just like Al, my friend, Vernon. They're selling, the client in Florida I was telling you about. They're selling their policy because they don't need, can't afford. And it's not like they need the money. They don't need the money. The money's nice, it's lovely, right? But it's not like they're desperate and they have to sell the policy. Not true at all. They're doing it because, like, why not? I'm going to walk away with little. I'm going to walk away with nothing. Why not get something for it? Only large face policies could be sold. Lisa, you only want those $1 million policies. Nope, $100,000, right around that mark. We can go a little bit below that. I sold an $85,000 policy for $10,000. It was a UL policy blowing up. Client was thrilled. So, but when you go down to the 15, 20, 25,000, sometimes even 50,000, there's just not enough money there for clients to even have it make sense. So think right around the 100,000 mark. We're very flexible. If you've got someone with a $75,000 policy or even a $50,000 policy, if someone has significant health issues, there may be enough money there for it to make sense for them. Only the $6 policy is not true. The investors are looking for people with 10 to 15 years of life expectancy or less. Sometimes 20. We have some pension funds that will look out 20 years. They have a longer time horizon. That once again, the shorter that life expectancy, right? I have a life expectancy of 4, 5, 6 years. My policy is more valuable than somebody that has a life expectancy of 15 or 16 years. But the older I am, I'm 80 years old, I can be pretty healthy to fit into that life expectancy window. The younger I am, we have clients in their 50s, the more health issues to be able to fit in that 10 to 15-year life expectancy window. So I don't need to be on death's door, or as I was talking to an insurance agent yesterday, I do not need to be 1 foot in the grave and 1 foot on a banana peel. That's what people think sometimes. Not true at all in any way, shape, or form. Investors only want people in their 80s or 90s. Not true. We just talked about that. Clearly, if someone's 80 or 90, everybody's in the pool. Every investor's looking. But once again, we sell policies to people in their 50s. Clients do not have to sell their entire policies. Okay, so that was a great question answered that we talked about before. I'm going to answer that a little bit more deeply here. Term policies we already talked about. People can convert part of it and let's sell the other. We just worked with a client in Kansas, and he had a $1.25 million policy. He converted $200,000 for himself, and the agent called me and said, Lisa, we have 1.05 million. Can you sell it? And we did. Gentleman was in his mid to late 60s, about 66, 67, pretty healthy guy. We sold it for 10,000 and he was thrilled because he was going to walk away from it with zero. So once again, because he was younger, right, and he was pretty healthy, that's why it went for 10,000. If he was older and had more health issues, clearly we get more money for that part. But once again, he was thrilled. Or here's the other part. There can be a retained death benefit. So this is the answer specifically to that question about, hey, can my family have coverage? Yes, it's possible. It depends. There has to be a big enough offer on the policy. So instead of getting all cash, clients can get less cash and a retained death benefit for their beneficiaries if the economics make sense for the buyer. So what will happen is, maybe I had a client got $360,000 on $1 million policy. So instead of they wanted to sell the whole thing, so it was fine, but 360 instead of that on a retained death benefit, maybe they get 280, and I'm making these numbers up, and their beneficiaries receive a $150,000 death benefit when the client passes. This is not just for wealthy people, it is for everybody. And we are legal, as you well know, and this is not STOLI. I have financial advisors and insurance agents sometimes tell me, Lisa, how in the world can you do this? This is STOLI. STOLI is stranger originated life insurance. It's illegal. It should be illegal. In the day that was not that long ago, strangers were going up to seniors and saying, let me buy a life insurance policy on you. I'll pay the premiums. Here's some money. I'm going to give you money to be able to allow me to insure you and pay the premiums, and I'm the beneficiary. But there's no insurable interest. They were strangers. That is not what we are talking about here. We're talking about when these policies that we're selling were written 5, 10, 15, 30 years ago, who's the beneficiary? It's the spouse, it's the trust, it's the kids, it's the business partner. There is insurable interest in these policies when they were written. All we're doing is transferring ownership to another entity. Thank you, Grigsby versus Russell. Just the way I can transfer ownership of my insurance policy to you today. Same thing. We talked about the WIFI. Clearly helping clients, being able to attract potential clients. Commissions are available on the sale. Once again, we share 50-50 of the total commission, and also additional product sales. So this can be good for your business as well. How in the world do you talk to a client about it? It's really simple. If you're doing annual reviews, great way to talk to clients about, hey, does your life insurance policy still fit your needs? Keep your eyes and ears open for, has there been a death in the family? Do you know if my spouse has passed away? Maybe there's been a budget change. I'm now retired, and this doesn't fit in my budget. Or just in regular conversations with people, if they're your Medicare clients, they may tell you, hey, I just can't afford my life insurance premium anymore. If you do write life insurance, look at your block of business to see whose term policy is coming to an end or whose term policy is coming to the end of their conversion privilege. They will be thrilled to be able to sell a portion of the policy versus walk away with nothing. Or look for universal life policies that are starting to blow up or starting to implode, where clients are going to have to put more money into these policies. I have agents right now that are doing just that, and they're calling their clients saying, look, your policy is going to need a cash call. You will get a cash call in the next 5 to 6 months. Here's what's happening. Do you want to put more money in your policy? And if the answer is no, have you thought about selling it? Think about life insurance policy as an asset, right? Not as, oh, it's someone's life. It's an asset, and people can benefit from these policies. Is it right for your clients? I don't know. It's not right for everybody. Shouldn't be right for everybody. But it is right a lot of the time. Once again, we're the last stop. The clients have already talked to you about, what can I do with my policy? Can I keep it? Does it make sense to reduce the face amount? And maybe it does. But after all the considerations have been put into place and you've thought about that with your clients and the decision's been made to lapse or surrender, we're the last option. Now look at us, because we can be a good option for clients. So here we are. We are life insurance settlements brokers. It's a free, no obligation appraisal. Like I mentioned before, clients only pay commission when a policy is sold. And once they have their money, then you and I are paid commissions, which are disclosed. We have access to the market, which is important. We are here to drive value for clients' policies, because if people call the 800 number on TV, because there are advertisements on TV, they are good. We do work with them. But it's no different than me as a consumer going directly to an insurance company versus calling you as an insurance broker, right? You're the one that's there to get me the best deal. That's what we do. We're here to get the clients the best deal. If they call the 800 number on TV, the investor groups are trying to get the policy as cheap as possible, right? They're trying to acquire an asset. You're not going to go buy a car for the most amount of money. You're going to go buy a car for the least amount of money. That's what they're doing. No disrespect. If I'm in their shoes, I'd do the same thing. But we're here to bring in competition for these investors so that they maximize the value for a client's policy. I know when we market a policy, that is the best offer in the marketplace. That is the most amount of money that we can get for that client. We've got a $100,000 policy right now. The opening offer is $15,000, and we're at $50,000 right now. So we're here to help people benefit from their unwanted, unneeded, and unaffordable life insurance policies. Here's my contact information. And I am very, very grateful for your time. Amanda, is there any other questions I can answer? I want to make sure that I covered everything and there's no outstanding questions or concerns.
We are going to give everyone a couple minutes to put their questions in, and I'll read all the comments. And while we wait for that, I just want to thank you for doing the presentation today and also for sponsoring this presentation today as well. So all of you guys, Lisa took the time to sponsor today's event. So we're going to give her a couple extra minutes just to talk about her company and how she can help us in the future. We're getting a lot of thank yous. A lot of this is amazing. I thought this was amazing. I thought this was a really good CE. Someone said, Heather says, this is the best CE webinar I have been to. I would agree. You're a very, very good presenter. This is fascinating. Very interesting. Everyone is really loving it, so that's good. Happy
and I'm not passionate about what I do at all.
No, not at all.
And ladies and gentlemen, this is all, to be clear, and thank you, Amanda, and I just interrupted you, I'm so sorry. This is all we do. So my point is, I'm not here to sell annuities or Medicare. I'm in no competition with you at all. I am here to support you and support your clients. This is all we do. Any questions, anything else?
No more questions coming in. So just tell us real quick, Lisa, just how do people, when should they contact you? I want to also just point out, you guys, that Lisa's in California, so she started this presentation at 5:45 a.m. her time.
Coffee, ladies and gentlemen, that's all I'm saying.
Is there anything that we should know if we were going to send something to you to help us do something like this with one of our clients? How do we contact you? I mean, you've got contact information on here. Just tell us a little bit more about what it is that we need to do to engage with you before we all log off this morning.
So easy. It's so easy. There's no contracts, meaning that there's no obligations for you as either. Here it is. Call me, email me. I have a client, it looks like this. So all I would ask you to do is, obviously get the face value of the policy. What is in general, what does the client's health look like? Are they healthy? Do they have some issues? You don't need to go into details. It's not that big of a deal. Just in general, what does the health look like? If they have a policy like universal life or whole life that has cash in it, approximately what does a cash surrender value look like. If you don't know any of that, don't worry about it. Pick up the phone, call me. I'll tell you what to find out. We have agents that will say, Lisa, I want to be the contact to talk to my clients. So I would call, I'm here to do business the way you want to do business. Or I have some agents that said, Lisa, here's my client's name and phone number, go call them. Like whatever, however you want to work is fine with us. It doesn't affect the commissions at all. Once again, we're very, very flexible. I have agents that call me all the time. Hey, Lisa, got my first potential prospect. This is kind of what it looks like. Or they'll call me and say, hey, Lisa, got my first potential prospect. What should I ask? It really is really, really simple. Contact me, call me, email me. Absolutely delighted to be of service, thrilled to be of service. There's our website. You'll see our clients and agent testimonials on there. It's just a privilege to be here this morning, and I'm very, very grateful to all of you for your valuable time. I know your time is valuable. I hope this has been helpful for your business, for your clients. And like I said, it's just a privilege to be of service to you, and I'm very grateful for the opportunity.
Awesome, good deal. Well, there's no more questions popping in, nothing in the chat box. I think we're all good to go. I hope everybody has a wonderful Easter weekend. Lisa, I will pull all the information from the webinar. It'll take it about 10 to 15 minutes to download, and then I'll send it over to you so you can email everyone your contact information and our gift card winners today. Thank you guys so much. Have a wonderful weekend.
Thank you. Have a great day.